is Lynette, and I'm going to be with you this morning. And I want to welcome everybody to Crop Insurance Basics. One of the things I want to get started with and bring to your attention is under handouts. Under handouts is a 4-page flyer that actually goes along with our webinar this morning. So if you'd like to pull that off or follow along with that, I'd welcome you to do that. Let's get started. We're going to be with you probably for the next 75 to 90 minutes, so hopefully we'll get through with that. And I don't anticipate taking any breaks unless we run a little bit over that. But at this point, we'll start and let's go over this, our primary focus for this webinar. We have 3 objectives. Our first objective here, I want to go over a yearly program cycle. Also, we're going to go over the basics of the policy, and I want to cover crop insurance contracts with you this morning. Secondly, we're going to show all plans of insurance today and just do a little bit of a dive into each one and talk a little bit about cost and premium, and hopefully you'll get a pretty good idea on what might work for your farm. And lastly, we're going to discuss how to engage the services of a crop insurance agent. We're going to spend a few minutes just looking at the Risk Management Agency website, and I'll show you how to locate an agent in your area. As we get started, let's go over just a few statistics, and I'm basing this on December 2018 statistics, and this is just the top Pennsylvania crops. So let's just take a look here. First of all, this list is based on the number of acres planted. So corn here, we have over 639,000 acres planted. Soybeans is second on that list, and then we have pasture, rangeland, and forage with 62,977 acres planted, and then wheat. Also note there the policy count, the number of policies sold, and you'll also see the liability numbers. Now I'm just going to throw something out here. You'll notice here apples did not make the list as far as policies sold. However, the liability for apples is over $49 million. So that would be third in the crops listed there. Also, I'm going to throw out this statistic. The acreage in the policy count is low for whole farm revenue protection and grapes. However, the liability for those crops is actually higher than wheat. So hopefully that will give you some idea of the crop statistics in Pennsylvania. Let's take a look at this next chart. On this next chart is the percent of total acres with the listed cause of loss. I'm just going to point out the top 3 here. Note that we have drought, which is over 40% of the causes of loss in the United States. Now, this is not just in Pennsylvania. This is across the entire United States. So starting with drought, and then over 28% of the cause of losses are excess moisture. And then we have hail. And you can take a look at the rest of those causes of loss and the percent there on that chart. All right, so webinar highlights this morning. We're going to go over 6 different sections to the crop insurance basics. We're going to do a little bit of an insurance primer, and I kind of hesitated doing this, but I think I'm just going to throw out some basic definitions for insurance, and then we're going to zero in actually on the federal crop insurance contract. After that, we'll cover some coverage plans, the crop insurance cycle. I want to cover some highlights from the basic policy so you know what to anticipate when you locate an agent and talk to that agent regarding crop insurance. And last but not least, we'll go over how to locate an agent from the Risk Management Agency website. All right, so first let's dive into the insurance primer. As most of you know, the basic purpose of insurance is to provide protection against economic loss arising from adverse events. The insurance is the pooling or combining of enough small, unpredictable risks so that over time the losses for the combined group become statistically predictable. So the basis of any insurance is the law of large numbers. This basic law of mathematics means that as the number of exposures or participants increases, or as the size of the pool increases, the average result becomes more stable. What is a risky, uncertain, and burdensome possibility for an individual becomes in the combined pool of a measurable, relatively constant, and manageable event that can be statistically estimated. So by paying a share of the loss for the group as a whole, it is possible for an individual to avoid a loss that, if borne alone, potentially could cause major financial problems or complete business failure. The relatively small premium paid by the individual is considered the expense of avoiding the full adverse effects of the particular risk being insured. So, to summarize here, by definition, insurance is the means of protecting against unexpected loss. Everyone has insurance. Either you buy insurance from an insurance company or you insure yourself. When you self-insure, there are no premiums to pay, but in the event of a loss, you pay the full amount. In other words, with self-insurance, you have a policy with 100% deductible. All right, this is the final slide that I'm going to just go through covering basic insurance terms. So first of all, let's start out and talk about the risk for criteria. Unfortunately, not all risks are insurable. To be insurable, objects must be important enough to cause economic hardship to the insured if they're damaged and of sufficient number and quality to allow a reasonably close calculation of probable loss. Also, the potential loss must be accidental and unintentional. And when an adverse event occurs, the amount of the loss must be capable of being measured and determined. So let's take a look at the screen here. It says to be insurable, risk must meet this criteria. First of all, a loss would result in economic hardship. So what is a serious loss to one person may not be serious to another. The most economic use of insurance premiums is to protect against the most serious loss first. For this reason, most insurance policies have deductible amounts to avoid the expense of small claims. Secondly, the sufficient number and quality of units must be exposed to the same peril. So to predict probable loss to the law of large numbers, it is essential that a large number of similar, not necessarily identical units be exposed to the same peril. The units must be of sufficient number and quality to allow a reasonably close calculation of the probable loss. Let's take a look at the third bullet here, where it talks about occurrences must be accidental and unintentional. Although some losses are expected for the combined pool, specific individual losses should be unexpected. There must be some uncertainty surrounding the occurrence, size, or timing of the loss. Otherwise, there would be absolutely no risk. The risk must generally be accidental in nature, and the availability of insurance coverage should not reduce the incentive of the insured to prevent the loss or induce the insured to cause the loss to occur in an effort to fraudulently collect the indemnity payment. Last but not least, we have a definite time and place and somehow how to measure with reasonable accuracy. Loss procedures need to be established to determine if a loss occurred and its size before an insurer can safely assume the burden of risk. That is, for a loss to be insurable, it also must be difficult to counterfeit so that the true cause can be determined and the true extent of loss can be measured. If this isn't done, the insurer could be exposed to claims that would undermine program stability. So again, this is some basic insurance terms that would apply to anything like homeowners, auto, or anything like that. So now let's zero in more on the crop insurance contract and those crop insurance terms. In our next section of the webinar, I'm going to cover working together and also the actual contract. So first of all, let's take a look at the most popular plans of insurance. I'm going to discuss these in detail a little bit later in the webinar so you can think what might actually work for your farming risk. The most popular plans are the yield protection. Of course, we have two different revenue products. We also have a whole farm revenue protection and the actual production history plan of insurance. Also note the other additional plans of insurance on the right side of the screen. Those are area yield protection types of insurance. There's three different types. I have a slide or two that we will go in and so you can get a pretty good overview of what those are. All right, first, let's talk about the contract. This contract is a crop insurance contract. It's an agreement between the insured or the farmer and the approved insurance provider. Now, I want to make everybody to make note of the first acronym that you see there, because you're going to see this acronym in other slides. That acronym is AIP. It stands for Insurance Provider or Approved Insurance Provider. Further on that slide, you're going to see that the insured agrees to insure all the eligible acreage of the crop in the county. And again, the insurance provider agrees to indemnify the insured against losses that occur during the crop year. Let's take a look at the next slide regarding the contract. For yield or revenue protection, insurance covers the loss of yield or revenue, depending on the product that you choose, exceeding a deductible amount. Again, losses must be due to unavoidable perils. So those two slides just give you a little bit of an idea of what the crop insurance contract consists of and who it's between. All right, let's take a look at a few slides. I named these slides Working Together. We're going to take a look at 4 different entities and how they all manage to work together. Let's discuss how Risk Management Agency and the Federal Crop Insurance works with insurance providers to provide effective crop coverage through agents to the insured or again to the farmer. Let's first take a look at Risk Management Agency. Risk Management Agency oversees the crop insurance program. They administer premium discounts and provide support and outreach. They are under the umbrella of Federal Crop Insurance Corporation. Their role is to establish provisions, rules, regulations, and rates. Secondly, let's take a look at the approved insurance providers. They contract with licensed agents to market crop insurance, and the agent receives a commission. In addition to that, each approved insurance provider has a standard reinsurance agreement with Risk Management Agency. Currently, there are 15 insurance providers that are contracted with Risk Management Agency to provide crop insurance. Let's take a look next at the agent's role. The agent provides product and premium information for the insured. They also collect required information, including application, production report, and acreage report. Now, those 3 items have deadlines attached to them. And when I talk about applications a little bit further along in this webinar today, we'll discuss deadlines specifically for Pennsylvania. The agent also builds relationship with farmers, and they must stay current with the crop insurance program. So when I talk about staying current with the crop insurance program, each agent is required to receive at least 3 hours training every crop year. And if they're a brand new agent, they must have at least 12 hours of training before they even can begin to sell the product. And remember, I'm going to show you how to locate the agent towards the end of the webinar. And we'll take a look at the Risk Management Agency website to do that. Last, but certainly not least, and most importantly, we're going to talk about the farmer. The farmer has the ownership in the crop. They enter into a contract to insure it. Now, the farmer is obligated to report the required information, again, such as production, acreage, and whatever they choose on the application. They must pay the premium and the fees, follow the appropriate good farming practices, and then at the end of the season, notify the insurance provider in the event of a loss. They may receive an indemnity payment when the insurable loss occurs if guarantees are not met. So that covers the first part of our webinar. The second section, we're going to go into coverage plans. In this coverage plan, or in this part of the webinar, we're going to cover each plan of insurance and hopefully give you an idea of cost and maybe possible indemnities just based on a few examples that we've made up. So first, let's talk about insurable commodities and plans. There are over 122 commodities insurable in the United States, and they increase each year. Now remember, risk management offers those different commodities. In Pennsylvania specifically, Pennsylvania currently has 29 commodities that are available for coverage, and that's based on the December year-to-date reports. Some plans of insurance or some crops have more than one plan of insurance, while others have multiple plans to choose from. So an example of a crop that has more than one plan of insurance would be wheat. Wheat, you could purchase yield protection, revenue protection, and revenue protection with the harvest price exclusion. Now, if you're insuring grapes, grapes are only insurable under the RP-HPE plan. So this is the reason why we always recommend that you talk to an agent to see what plan would work best for your crop. And remember, the crop is insured under one plan per county. Let's talk a little bit about rates. Premium rates, terms, and conditions, again, are established by the Federal Crop Insurance Corporation. And there again is that acronym FCIC. You'll see that several times through our conference today. Secondly, unlike other types of insurance, federal crop insurance rates are the same for all insurance providers. So all 15 insurance providers has the exact same rates. There are 3 different crop insurance types. All 3 are sold and serviced through private companies. Both the yield coverage and the revenue coverage are regulated through RMA. Both are commonly also referred to as multi-peril crop insurance. You might hear 2 different terms. Multi-peril crop insurance is by far the most popular. Other people refer to the yield coverage and revenue coverage as federal products. The third type of crop insurance is crop hail insurance. This is regulated by the state insurance departments. I will say one thing about crop hail insurance. If you're interested in that product, I would certainly encourage you to sign up for the webinar that will be offered on January 15th. It'll be offered at the same time as today's. And like I said, if you want more information or want to dig deeper into that product, we will have a webinar next week for that. All right, so let's take a look at this chart. On this chart, we have federal crop insurance in the middle column and private crop hail insurance on your far right column, and we're making comparisons between 4 different topics there. The first one is regulator. Risk Management Agency regulates federal crop insurance. Again, that includes your yield protection plan or revenue plans, whole farm risk protection. Those sort of plans are all under the federal crop insurance umbrella. As far as private crop hail, those are the state departments of insurance. There are premium discounts available for certain types of plans of insurance, and we'll dig a little bit deeper into that. And is there a premium discount for private crop hail insurance? This chart says no, but some companies do offer premium discounts based on if they're a member or an associate of that company. So that will just depend on what company you sign up with. Premium rates are set by Risk Management Agency, and for crop hail, they're set by individual companies. Perils covered under the federal crop insurance, it's an all-risk basis. The yield losses are due to natural causes. Also keep in mind that revenue losses are due to price movements in addition to yield losses. For private crop hail, there's a named perils basis. Losses are due to hail and other things such as fire, lightning, transit, etc. All right, so let's take a look at our very first individual plan of insurance. That's the actual production history plan. I want to touch on this product first because it is the oldest federal crop insurance product that we have. It provides protection against a loss in yield due to nearly all unavoidable natural occurring events. So when we talk about unavoidable natural occurring events, those would include drought, excess moisture, cold frost, the wind, flood, other unavoidable damage from insects or disease. If you remember the third slide in this webinar series, that was a chart that gave you the percentage of losses that occur throughout the United States. So that's kind of the same thing. This also guarantees a yield based on the individual producer's actual production history. The insurance guarantee is calculated by multiplying the approved average yield per acre by the elected coverage level. Now, our federal crop insurance offers quite a few different coverage levels. They start at 50%, go up to 75% in 5% increments. Also, 80% and 85% are also available for some crops. The indemnity may be due if production is less than the guaranteed amount. Price elections are established by the risk management agency. Price elections are released before sales closing date. This type of product does not apply to crops that do not have revenue coverage available. Let's take another additional look at this slide. Again, we're talking about the actual production history plan. The actual production history is 4 to 10 years of historical yields. The producer's actual production history is simply the yield produced on a particular piece of ground. That ground is insured as a unit over the last 4 to 10 years. An average of these historical yields are used to calculate the insurance guarantees. Now, there are still a few crops in Pennsylvania that still have the APH as a plan of insurance. Some examples of this are apples, cabbage, cigar filler tobacco, forage production, grapes, oats, potatoes, and there's probably a few more, but those are the main ones. Again, the coverage levels range from 50 to 75% in 5% increments. Some crops do have 80 and 85% levels available. The coverage level sets the producer's deductible. So what we mean by that is if 75% coverage is elected, the deductible is 25%. So any covered loss greater than 25% will result in a loss payment. I'm only going to spend one slide talking about the catastrophic risk protection. And catastrophic risk protection is not necessarily an individual plan of insurance, but it's an endorsement that provides the minimum level of coverage offered by risk management agency. A catastrophic or CAT policy, again, notice that acronym CAT, is a policy with a 50% coverage level and a price election equal to 55% of the price election. CAT coverage is the lowest level of protection available under the NPCI program. So you'll notice there in the second column, it says there's a $300 administrative fee. So here's a little bit of a trivia for you. The 2018 Farm Bill will increase the CAT fees to $655 per crop. That's an oddly specific dollar amount, but that's what you can anticipate with the new Farm Bill. All right, let's talk about the actual production history component a little bit, since it does apply to almost all plans of insurance. Remember, we do have an APH plan of insurance. That was the previous two slides, but it's also a crop insurance term used to describe one of the most important components in crop insurance. As discussed earlier, APH is simply a way of averaging a producer's yield over a 4 to 10 year time span. The APH average yield is then used to calculate the producer's guarantee, and it also determines the premium rate. Every year that the producer is in the crop insurance program, he or she must report the actual production from the previous crop year. The production reporting deadline is the earlier of the acreage reporting date or 45 days after the cancellation date. So for example, a spring planted crop at the sales closing date on March 15th, and March 15th is a sales closing date for Pennsylvania, and an acreage reporting date of June 15th has a production reporting deadline of April 29th. This is 45 days after the production or after the cancellation date. Now, let's take a look at the third bullet in your slide, and we're going to get a little bit deeper into if your insured does not have 4 years of actual records for a crop on a particular unit. Variable transitional yields, also known as T yields, are used to complete the 4-year database as shown in the slide. T yields are based on the county 10-year average. The percentage of the T yield is determined based on the number of APH years with an actual yield. So for instance, if no actual records are available, the 4-year database will contain 4 65% T yields. If 1 year of actual records is combined with 3 80% T yields, 2 years of actual records are combined with 2 90% T yields, and 3 years of actual records are combined with 100% T yield. So once 4 more years of actual yields are available, the T yields are dropped off and no longer used. So as more years of production history are reported, the insurance yields more accurately reflect the individual's insurance capability of producing the crop. Last but not least on that slide, let's talk a little bit about new producers. This is a term assigned to producers who have not produced the insured crop in the county for no more than 2 crop years. These producers do not have the ability to provide the 4 years of record simply because they have not been farming the crop that long. So these producers can receive 100% of the T yield rather than a percentage of it. All right, so let's move on into the next individual plan of insurance. Remember, we've already covered the actual production history plan and then the endorsement, which is the CAT endorsement. So this is now the yield production plan, or I'm sorry, the yield protection plan. The acronym for that is YP. This particular plan protects against a loss of production. Now, let's take a close look at the second bullet here. This works the same as the APH plan, but the price is established according to the Crops Commodity Board of Trade or Exchange. The Commodity Board of Trade for Pennsylvania is the Chicago Board of Trade. Again, it is the Chicago Board of Trade for Pennsylvania. It is calculated by multiplying the average yield by the level of coverage by projected price. This type of plan is only available for crops that also have revenue protection available. So again, I want to stress the second bullet. This works the same as the APH plan, but the price is established according to the Crops Commodity Board of Trade. So let's take a close look at a yield protection plan example. And I would pay attention especially to the left column because I'm going to be using the information from the left column in several other examples for different plans of insurance I'm going to show. So this is a corn example, non-irrigated corn. We have 250 bushel approved APH yield. Our policyholder chose the 80% coverage level, and $3.96 was based on the price, and I'm using last year's price released by Risk Management Agency for conventional corn. Obviously, this year's price hasn't been released yet. It will get released closer to March 15th. Now, that fourth item here, it says 185 bushels to the acre actual production. So let's pretend that's what the policyholder actually harvested. And in this case, we're going to have a loss due to drought. So we have a loss payment here. And to get to that loss payment, we have to calculate a yield guarantee. That yield guarantee is calculated by taking the 250 bushel approved APH yield times the coverage level of 80%, and we come up to 200 bushels per acre. Now, in order to calculate the yield loss, we have to take that 200 guarantee and subtract that from the 185 bushels actual production that they harvested, and we end up with a 15 bushel acre. So the loss payment is the 15 bushels times the price election, and we end up with $59.40. Again, this is based on if the policyholder had 100% interest in the crop. So that's a real quick way to calculate a yield protection loss example. All right, let's move on to the next plan of insurance. We call this the Revenue Protection Plan. The acronym for that is RP, and this is by far the most popular plan offered throughout the United States. This provides protection against a loss of revenue caused by price increase or decrease, low yields, or a combination of both. Now, one thing I do want to point out here is that the corn silage protection is only provided for production losses. And I only bring that to your attention because I know there's some corn silage that's offered in the state of Pennsylvania. Moving on to the next bullet, coverage guarantees an amount based on the farmer's APH and the greater of the projected price or harvest price. Again, both prices are established through the Chicago Board of Trade. An indemnity may be due when the calculated premium, which is the farmer's current year production times the harvest price, is less than the revenue protection guarantee for the crop acreage, and losses are paid using the harvest price. Now, in addition to that, I want to bring up a couple of other points. While the revenue production guarantee may increase, premium will not. And secondly, the projected price is used to calculate the premium and replant payment or preventive planning payment. Now, I haven't talked anything about preventive planning payment yet, so you might want to just hold that thought in the back of your mind for just a few minutes. We will talk about preventive planning payments towards the end of the webinar. Also, generally, crops such as corn, soybeans, wheat, and others are covered under this plan. All right, so let's take a look at our first example here for revenue protection. And note here at the very top of the slide, we have this example covers a yield increase and the harvest price decrease. Again, on the right side of the slide are the same items as we talked about under the yield protection example. We have the 250 bushel approved APH yield, 80% coverage level. Projected price is $3.96. Revenue guarantee is $792. Now remember, in order to get the revenue guarantee, if you go to the second column, you need to take the 250 approved APH yield times the coverage level times the price election to get the $792. In this instance, we're going to say that the farmer harvested 255 bushel actual production. And then, remember, this product now has a harvest price that's released closer to harvest, and that is a $3 harvest price. And in this instance, we have a loss due to price decline. So let's talk a little bit about that second column. Specifically, again, I want to review the 792 revenue guarantee. We get that by taking the 250 bushel APH times the projected price of $3.96 and then multiply that times the coverage level. Revenue protection pays an indemnity when the revenue falls below the guarantee. So the revenue equals the actual yield from the insurable unit times the harvest price. So in this instance, we're going to take the actual bushels that he harvested of 255 and the $3 harvest price. The $3 harvest price is below the projected price, so the revenue guarantee does not increase. In this case, the revenue is $765 per acre. And remember, you get that by taking the 255 bushel yield times the $3 harvest price. Since the revenue is below the guarantee, the revenue protection plan makes an indemnity payment equal to the difference between the guarantee and the revenue, or in this case, $27. All right, so that's the first example I want to show you. Remember, that was the yield increase and the harvest price decrease. Let's go to the next example, which is just the opposite. This is a yield decrease and a harvest price increase. So with revenue protection, the revenue guarantee increases when the harvest price is above the projected price. So remember, in this example, we're going to assume a harvest price of $4.50. This exceeds the projected price of $3.96. In this case, the revenue guarantee is increased to $900. Okay, you can see that in the second column, the first bullet. We get that by taking the 250 bushel APH yield times the $4.50 harvest price and then the coverage level. So in this case, we're going to assume a yield decrease here of 185 bushels to the acre that the farmer actually harvested. This is actual production. So you would take the 185 bushels harvested times the $4.50 harvest price and come up to with the $833 of revenue. The per acre indemnity in this case is $67. You can take a look at that on the last bullet, the second column. In this scenario, they get paid $67 per acre for indemnity. No additional premium is paid. All right, so let's move on to the next plan of insurance. It's called the Revenue Protection with the Harvest Price Exclusion Plan. This plan is pretty much exactly the same as revenue protection. However, there's a huge difference here. The revenue protection with the harvest price exclusion provides protection against loss of revenue caused by the price decrease, low yields, or a combination of both. So in this case, the producer does not receive the benefit of the upward price movement with this plan. Unlike revenue protection, the revenue protection guarantee for this product is based on the projected price only, and it does not increase based on a harvest price. Again, crops such as corn, soybeans, barley, and wheat are eligible under this plan. All right, so let's take a look here at a couple of examples I have. This is the yield increase and the harvest price decrease. So as before, we're going to assume that a corn producer has an approved yield of 250 bushels approved per acre. We have a $3.96 projected price. So the revenue guarantee for the 80% coverage level equals $792 per acre. And you can see that calculation in the second column. Indemnity payments occur when the revenue is below the revenue guarantee. So an actual yield of 255 bushel per acre and a $3 harvest price results in a revenue of $765. Note the $3 harvest price there. So the 255 bushel actual times the $3 harvest price will result in a $27 indemnity. This is exactly the same payment as the results under the revenue protection given the same APH yield and coverage level as shown in the example. Revenue protection with harvest price exclusion produces the same indemnity amount as the revenue protection when the harvest price is below the projected price. So that's the difference with this product. Now, let's take a look at this product when the harvest price increases. Let's go to the next slide. Okay, so in this instance, indemnity payments will differ between the two options when the harvest price is above the projected price. So note here what the harvest price is. It's $4.50. So for example, if the harvest price is $4.50 and you take the 255 bushel actual production, you would get $1,148 of revenue, which is well above the revenue guarantee. And you can see that in the second column. The revenue guarantee is originally $792. When we take it and multiply it by the harvest price at harvest time, the revenue is now quite a bit more than the revenue guarantee. So the difference between the two products is when the harvest price is higher, you do not get the benefit of the increased revenue guarantee. The farmer would still have similar results if the actual production harvested was lower. So the bottom line is without harvest price exclusion, this actually would be a $900 indemnity payment. But since again, the difference between the two products is when the harvest price is higher, you do not get that benefit. So keep that in mind as the main difference between the revenue protection. All right, so let's take a look at the next slide, and we have one more slide before we're going to give you a poll question. But I want to talk about coverage levels and pricing first. We talked a lot about price percentages and price projected and harvest price throughout the last few examples. So let's discuss that a little bit. First of all, the price percentages for the APH plan and the yield protection plan, the farmer actually has the option to select the percentage of the price selection based on their level of coverage. So you can see based on the chart down there, if the farmer chooses a 70% coverage level, he can also choose anywhere between 72 and 100% of the price released by a risk management agency. So there's the different types of price percentages on that bottom line of that chart there. And that's all dependent on what coverage level they choose. However, for revenue protection and the revenue protection harvest price exclusion, the projected and harvest price will always be 100% of the projected price and harvest price issued by a risk management agency. I will tell you that most farmers do stick with 100% of the price regardless of what plan of insurance they choose. But however, I just wanted to show that this is just an option. All right, so let's take a few seconds out for our first poll question. That first poll question we're going to bring up here. It asks you, what are some federal plans of insurance? And I want you to choose all that apply. So that means there's going to be more than one answer. So I'll give you a few seconds to do that. Okay, and we're going to do another poll question here. I just forgot that we had two almost here in a row. So we're going to pull up the next poll question. This one asks you, which plan of insurance provides protection against a loss in yield and or revenue? This is only one correct answer for this one. All right, so if you answered revenue protection to that, you would be correct. All right, let's move on here into another individual plan of insurance. This is the whole farm revenue protection, and most commonly you see this referred to as WFRP. That is the acronym for whole farm revenue protection. This is a pretty big product that's gaining a lot of popularity. I want to bring it to your attention. I'm just going to do a few slides on it, but I will have some more information about this product that I want to talk to you about. So let's discuss what exactly does this cover. This is revenue from all commodities produced on the farm during the insurance year. This includes animals and animal products, commodities purchased for resale up to the 50% of total. It excludes timber, forest products, and animals for sport, show, or pets. There's also replant costs for annual crops with approval on this one. What are the features of this product? The big thing here is all farm revenue is insured together under one policy. Individual commodity losses are not considered. It is the overall farm revenue that determines the losses. A premium discount is available, and it does depend on the farm diversification. So a farm with 2 or more commodities receive the whole farm premium discount. Farms with only 1 commodity receive the premium or the basic premium discount. Some features of whole farm: it does offer coverage levels between 50 to 85% in the 5% increments like the other products. Diversification of 3 commodities required for the 80 and the 85% coverage level. There is no CAT level of whole farm revenue protection available. The historic revenue is adjusted to reflect the farm expansion. So we will have a webinar that goes a little bit deeper into the automatic indexing process. Also, expanding operations provision allows for up to 35% growth over the historic average with insurance company approval. What kinds of farms may benefit from this product? This is well suited for the highly diverse farms with special commodities, farms that might sell to direct markets, specialty markets, some regional markets, farm identity preserve markets. It's available to all farmer ranches that qualify, and there are some limits for qualification. So if you're interested in this type of product, what exactly will the agent need from me? So the first thing the agent's going to need from you when you sign the application is the 5 years of farm tax forms. So for 2019, it requires tax forms from 2013 through 17. Exceptions are made for beginning farmers and ranchers, and you can talk to your agent if you qualify for beginning farmer or ranchers. Need to know if you are a calendar year tax filer or a fiscal year tax filer and what your fiscal year is. And information about what you expect to produce on the farm during the insured year. That information is used to complete the intended farm operation report. There are other information that might be needed, such as supporting records, any organic certification, inventory or accounts receivable information, also beginning inventories of stored commodities and livestock. So that's all I'm going to discuss regarding the whole farm revenue protection product. And the slide in front of you now is something I would certainly encourage you to enroll in. We are going to have very specific webinars regarding this product offered on February 5th and 7th. There will be different content in each of those webinars. So if you want to sign up for both of them, I would certainly encourage you to do that. You would need to register now for that information. All right, so one last thing when we talk about additional plans of insurance are the area plans of insurance. Now, I will say this, I only have one slide for area plans of insurance. It's not a real popular product, but I do want to make sure you know that it's offered and it is available. So let's talk a little bit about that. This is a type of plan that provides coverage based on the experience of an entire area, which is generally a county. So this type of product would include the area yield protection, area revenue protection, and area revenue protection with harvest price exclusion. There are 3 plans under the area's plan of insurance. It provides protection against the widespread loss of revenue or loss of yield in a county. So why we're saying in a county, if you take a look at the 3rd bullet, this is pretty important. Individual farm revenues and yields are not considered under area plans of insurance. So it is possible that your individual farm may experience reduced revenue or reduced yield and still not receive an indemnity under this product. National Ag Statistical Service county data is used to set the expected and actual county yields. And in this instance, the insured chooses a percent of the expected county yield or revenue when they sign up for this type of plan. So that is all the plans of insurance under the federal crop insurance umbrella. Let's move on next to a poll question. The poll question asks you, what is the difference between revenue protection and revenue protection harvest price exclusion? Again, there's only one correct answer for this. So I'll give you a few seconds to determine what that answer might be. All right, so our next part of our webinar is going through the crop insurance cycle. This won't take very long at all because the crop insurance cycle is fairly forthright and pretty easy to understand. So let's take a look at the first part of the crop insurance cycle. The crop insurance cycle begins each year with the insurance offer. This is also known as the application process, and that's at the very top of the cycle. Actuarial documents are published annually by Risk Management Agency. They list the plan of insurance, the crop, type, variety, and practice that may be insured in a state and a county. It also shows the available insurance options, levels of coverage, price selections, premium rates, and premium discount amounts. Also, special provisions list the program calendar dates and special statements which may further define, limit, or modify the coverage. So let's actually talk about the application process. Here is a slide that talks about the application must include the coverage plan, county crops, coverage level, price endorsements, entity type, and other information. So I would tell you right now you need to plan to spend some time with your agent completing this form. One mixed box can have a great impact on your coverage. A reminder that sales closing date is March 15th for spring crops, September 30th for fall planted crops. Upon receipt of a properly completed and timely submitted application, the insurance provider processes it, and then a summary of coverage is issued. Policy documents are sent to you. Once the application is accepted, the policyholder may not cancel the policy for the initial crop year. For annual crops, insurance attaches when planting begins on the insurance unit. The crop must be planted on or before the final planting date unless late or preventive planting coverages apply. If a crop cannot be timely planted due to causes specified in the crop provisions, such acreage may be eligible for a preventive planting payment. The insurance cycle continues with coverage requirements. So let's talk a little bit about coverage. First of all, let's go through the actual production history. By the earlier of the production reporting deadline or acreage report date, the farmer must report production acreage for actual production history. Unit options, which we're going to discuss here in a few slides, for your particular farms will also be discussed. Actual records must be submitted to your agent to prepare the production report. In addition to reporting production, you also must report acreage. The farmer must annually report for each insured crop in the county the number of insurable and uninsurable acres planted or late or prevented planting if that is applicable, the date the crop was planted, your share in the crop, acreage location, farming practices, all on or before the applicable acreage reporting date. This information is used by the insurance provider to establish the amount of coverage and premium for the crop. Deadlines must be adhered to, otherwise coverage may be denied. The acreage reporting date for spring crops is generally July 15th, but you will need to check with your agent for that. The last bullet is the summary of coverage. Once the acreage report is processed, the farmer will be issued a summary of coverage. And again, if that information is not correct, you will need to contact your agent. The insurance cycle continues now with premium billing, which is at the very bottom of the crop insurance cycle. Annual premium is earned and payable at the time insurance coverage begins. However, premium is not owed in advance on the policy providing the coverage until after harvest. A billing is issued based on the information contained in the acreage report. Your billing dates are specified in your actuarial documents. The billing does contain both premium and administrative fees. Administrative fees are generally charged for additional coverage products, and they're usually $30 per crop and per county. The cycle does continue with the claims process. Let's take a little bit closer look at that claims process. Specifically, let's talk about the notice of damage or loss of production and those deadlines related to that. A written notice of damage or loss of production for each unit is to be filed by the farmer within 72 hours of initial discovery, no later than 50 days at the end of the insurance period. Let's talk a little bit also about end of insurance period. This is the last date the insurance coverage ceases for the crop. This can mean the total destruction of the insured crop, harvest of the insured crop, final adjustment on a loss on a unit, or the calendar date contained in the crop or special provisions. As far as important deadlines for revenue coverage, the revenue loss on a revenue protection plan is no later than 45 days after the latest date the harvest price is released. For preventive planting, it's no later than 72 hours after the final planting date, or if it's determined that replanting is not possible during that late planting period. Preventive planting must also be reported on the acreage report. Once you report that you have a notice of loss, the next step in that is an inspection. The insurance provider will receive the notice of loss. They will contact the farmer, they visit the farm, inspect the damaged crop. If the crop has not been harvested, then appraisal is made using federally approved loss adjustment procedures. One thing I will say about that, every single insurance provider uses the exact same loss adjustment procedure. If the crop is harvested, bushels will be determined by measuring a storage structure or bushels taken from scale tickets from an elevator. Once all that is done, the claim is in process, an indemnity check and a summary of loss will be issued, and any deductions to the indemnity amount for outstanding premium or those administrative fees. All right, last but not least in the crop insurance cycle is the program changes. So let's talk a little bit about the program changes. For your information, the crop insurance policy may be changed year to year by RMA, or Risk Management Agency. And once those changes are released, the insurance provider does notify the farmer in writing no later than 30 days prior to sales closing or the cancellation date. The farmer will review the changes at that time with their crop insurance agent. They have the option to continue coverage, change the policy coverage, or cancel that coverage. All changes to the policy or cancellation must be by written notice and submitted on or before the sales closing date. So let's do one more poll question here. The next poll question asks, when must an application for corn in Pennsylvania be completed? And this one only has one answer. I'll just give you a few seconds to complete that. All right. The correct answer for that poll was actually March 15th. So if you check mark March 15th, you would be correct. All right, so let's wrap this crop cycle portion of the webinar up. Let's just briefly go over the producer obligations. Let's take a look at the first bullet here. When you use crop insurance as a risk management tool, remember you must accurately report your acreage planted. If you underreport your acreage, your yield will be artificially inflated and you will receive a lower indemnity payment. On the other hand, if you've overreported your acres, the production account will be derived from all planted acreage for that crop per unit. The acreage will be reduced to the correct number of acres. Secondly, let's take a look at the next bullet. There are specific deadlines that must be met throughout the crop insurance year or cycle of your policy in order for your coverage to be valid. You are also responsible to pay the premium when it's due. And lastly, it is important that you are aware of final planting dates and other specific information for the particular crop you are insuring. All right, so that wraps up the crop insurance cycle. Let's move into the basic provision highlights. I will say this, the common policy is fairly detailed, so I'm just going to give you a handful of issues for you to be aware of before you visit your agent for the first time and hopefully sign an application at that point. There are some things you need to know. So let's first start with the causes of loss. Remember, I did indicate that the insurance is provided to protect against unavoidable naturally occurring events. Take a look at the slide. Those are all the unavoidable naturally occurring events. Causes of loss are actually found in your specific crop provisions. However, I think you should know them before we actually discuss what is not covered. So let's take a look on the next slide to determine what is not covered. This is a general list. Any act by a person that affects the yield quality or price of the insured crop. There's some examples listed there on the first bullet. Failure to follow recognized good farming practices. I'm going to cover that in a couple slides. Water that's contained by or within structures that are designed to contain a specific amount of water, such as dams, locks, or reservoir projects on any acreage when water stays within the designated limits. Failure or breakdown of the irrigation equipment or facilities, or the inability to prepare the land for irrigation using your established irrigation method. Failure to carry out a good irrigation method. Any cause of loss that results in damages that are not evident or would not have been evident during the insurance period. All right, so let's take a look at good farming practices. Let's take a first look at the first bullet. This is actually the definition or part of the definition for good farming practice. Production methods utilized to produce the insured crop and allow it to make normal progress toward maturity and produce at least the yield used to determine the production guarantee or amount of insurance. Some uninsured causes of loss due to failure to follow good farming practices might include failure to plant the recommended quantity of seed or transplants. Another one might be improper seedbed preparation, failure to properly plant or care for or harvest the insured crop. Those are just a few of them, or some insured causes of losses for failure to follow good farming practices. There are others that are listed in a handbook. Failure to follow recognized good farming practices adapted to the area which have been successfully carried out by others producers in the area. Some of these are, and if you take a look at the bottom half of the slide, some of these are seeding methods, fertilization, timing and rates, row spacing, and you can read the others listed there on the bottom part of the slide. Next is the conservation compliance. This is an AD 1026 form. Farmers must comply with the highly erodible land conservation and wetland provisions to be eligible for the premium discounts offered by a risk management agency. That Form AD 26 must be on file with the Farm Service Agency on or before the premium billing date. This form covers all land in all states and counties in which the person has an interest. And I would certainly advise you to check that status by asking your crop insurance agent if you are in compliance, or on the other hand, you could contact your local Farm Service agency. The next part of the basic provisions is the unit selection. Unit structure is one of the most important parts of your crop insurance plan. Let me go back one here. It is important that you discuss with your crop insurance agent what best fits your farming operation and how you keep your production and acreage records. So you can see the 4 options listed there on the screen. I'm going to take a deeper dive into all 4 of them. Let's start with basic units on the next slide. Basic units is something the insured automatically qualifies without exception. A basic unit, unless it's otherwise specified in the crop provisions or special provisions, is all insurable acreage of the insured crop in the county on which the date coverage begins for the crop year in which the insured has, number 1, 100% share in the crop. This includes share as an owner-operator or land that's rented for cash, a fixed commodity payment, or any consideration other than a share in the crop. Number 2, less than 100% share in the crop, land owned by one person and operated by another person on a share basis. A crop shared with each different landlord, tenant, or sharecropper is considered a basic unit. All right, let's next take a look at optional unit overview. Optional units are available only for additional coverage policies such as yield protection and revenue protection. They are available for sections or section equivalents in most areas and must be available by irrigated and non-irrigated practices within a single section. Note there what it takes to qualify for an optional unit. Production reports must be filed for at least the most recent crop year in the base period. Crop must be planted in a manner that results in a clear and discernible break in the planting pattern. The insured must have acceptable production evidence for the most recent APH crop year of planted acreage and production. Now, at loss time, this is the good thing about optional units. Each optional unit stands on its own. This is most obviously the most popular unit option that's offered by risk management agency, and it does cost a little bit more than the other unit options. The third unit option is enterprise unit. And this is just an overview. Enterprise unit is a little bit more complicated than what I've set out here on this slide, but let's just take a quick overview of it. An enterprise unit consists of all insurable acreage of the same insured crop, or all insurable irrigated or non-irrigated acreage of the same insured crop in the county. So taking a look at the second column, here's what you can elect. You may elect separate enterprise units by irrigated and or non-irrigated practices if it's allowed by the actuarial documents. This is only available on additional coverage policies. It must be elected on or before the earliest sales closing date, and election is continuous. There are additional qualifications to qualify for an enterprise unit, so it's important that you discuss this option thoroughly with your agent. The enterprise unit does qualify for a discount. Here's something brand new that was released just a couple of weeks ago. That's how new it is. It's called the Multi-County Enterprise Unit. This is a new endorsement that allows small amounts of acreage from one county into an enterprise unit for a contiguous county. It allows a producer to combine acreage of an insured crop by irrigation practice, if that's applicable, in 2 contiguous counties in the same state into one enterprise unit. Take a look at the bottom of the slide and you can see how you might qualify. This is available for counties in which the actuarial documents include this option for the following crops. Mainly they'll be available for small grains, coarse grains, cotton, peanuts, rice, canola, and sunflowers. And like I said, that's so new, I would certainly encourage you to discuss this option with your agent. Last but not least is the whole farm unit overview. The whole farm unit consists of all insurable acreage of all insured crops planted in the county in which the insured has a share. This must contain all the insurable acreage of at least 2 crops, and at least 2 of the insured crops must each have planted acreage that constitutes 10% or more of the total planted acreage liability. Whole farm units are only available for additional coverage policies, and it's generally for revenue policies, must be elected in writing. And in case you haven't caught on to this yet, as far as a loss payment goes, it's very hard to get a loss payment on this type of whole farm unit. Production reports for all the unit structures discussed, the whole farm, enterprise, optional, basic unit, must be filed by the production reporting deadline. All right, since we're talking about unit options, let's discuss record retention. Complete records of the planting, replanting, inputs, production, harvest, and disposition of the insured crop on each unit must be retained for 3 years after the end of the crop year. The insurance provider, along with any employee of USDA, has the right to examine the insured crop and all records to the insured crop. Some additional information is the farmer must have acceptable production evidence to support the information on the production report. So an example of this, if insured A submits a production report certifying production for the 2015 through the 2018 crop years used for the 2019 APH database, all evidence substantiating the 2015 through 2018 crop year production must be retained until the calendar date for the end of the insurance period of the 2022 crop year. Also remember that measurements from farm store production are also acceptable for crops such as corn, oats, soybeans, and wheat. It is very important that farmers keep separate measurements of production by unit when placed in those farm storage structures. All right, folks, this is your very last poll question before we finish the webinar. So let's bring it up. The poll question asks, what unit structure does an insured automatically qualify for? And there's only one answer to that. All right, just a few more things in the basic provisions that I want to highlight. One of the things that is becoming more and more important are organic crops. So I just want to give you a quick overview on what is in the basic provisions. Crop insurance is provided for organic farming practice if it's specified on the actuarial document or if it's allowed by a written agreement. The bottom line is you still need to contact your crop insurance information or your crop insurance agent for that specific information. The following acreage is insurable. Take a look at your second column there. Certified organic acreage along with transitional acreage being converted to certified organic acreage is covered. That transitional process is generally 3 years. Buffer zone acreage is also covered. A written organic certificate must be in effect from a certifying agent indicating, and all the following must be included on that certificate that's located there in the third column. Price elections can also be found in the special provisions. Price elections are the value per pound, bushel, ton, carton, or other unit of measures for the purposes of determining premium and indemnity under the policy. So focusing mainly here on organic crops pricing, contract pricing is available for organic and transitional acreage under the crop price addendum. Organic prices for yield protection and revenue plans for both projected and harvest price are also available in certain areas and certain crop types. The next part of the basic provisions that I want to discuss is person type. So in order to obtain insurance, the applicant needs to report the correct person type along with the correct identification number. I just listed 4 examples, and these are the most popular 4 examples of a person type. They're individual, spousal, partnership, corporation. Many other person types are available, so don't think that this is all conclusive here. Each person type requires either a social security number or an employer identification number. Mainly social security numbers are acceptable for individual and spousal policy, while the employer identification numbers are expected for partnerships, corporations, revocable trusts, and LLCs. Along with reporting your personal type, substantial beneficial interest, also known as SBIs, are expected to be reported by sales closing date. So all persons with an interest of at least 10% in the insured must be listed along with their identification numbers. I don't want you to get this confused with persons sharing in the crop. This is persons with interest of at least 10% in the applicant. So what this means, I'm going to give you an example. If you are insuring a partnership, you apply for coverage using the partnership. However, you also need to report all persons involved in the partnership. So on the application, you would report the employer identification number for the partnership, and then the persons with a substantial beneficial interest would also need to be listed along with their social security number. All right, let's tackle next preventive planting. I've mentioned preventive planting throughout this entire webinar, and I have about 3 slides on it that I just want to briefly go through. First of all, let's take a look at the definition of preventive planting in the first column. This is something that provides farmers valuable protection in the event they are unable to plant an insured crop by the final planting date or during the late planting period due to an insured cause of loss. So when adverse weather prevents planting, a preventive planting payment is made to compensate for the producer's pre-planting costs generally incurred in the preparation for planting the crop. Pre-planting costs generally include the purchase of machinery, perhaps land rent, fertilizer, pesticide, labor, that sort of thing. Preventive planting coverage is calculated as a % of the insurance guarantee the insured would have had for the timely planted crop. So let's take an example here. Suppose a farmer's insurance guarantee is $100 an acre. If the producer insured a crop with a 60% preventive planting coverage factor, the preventive planting payment would be $60 or 60% of the guarantee. Also note here that the preventive plant factor varies by crop based on the estimate of pre-planting costs. For example, for corn, the preventive planting factor is 55, soybeans and wheat and oats are 60, and potatoes are 45%. Let's move in next to the preventive planting provisions for drought. This is available for most crops and covers lack of precipitation and drought that occurred during the insurance period and that prevent other farmers from planting acreage with similar characteristics. So to be eligible there, take a look at the last 2 bullets. That gives you some idea on how to be eligible for the non-irrigation due to drought. Moving on to preventive planting provisions for flood, which is also could be excess moisture. That is available for most crops and covers floods, hurricanes, or excess precipitation that occurs during the insurance period that prevents other producers from planting acreage with similar characteristics. So if you are prevented from planting your acreage, you're required to provide a notice that you were prevented from planting an insured crop within 72 hours after the final planting date. If you do not intend to plant the insured crop during the late period, or if the late planting period is not available, or if you determine you will not be able to plant the insured crop within an available late planting period. Also note that acreage that's prevented from planting must be reported on your acreage report, meaning that premium will be due on those acres that are prevented from planting. Lastly, let's discuss written agreements. A written agreement is a document designed to provide crop insurance for insurable crops when coverage or rates are unavailable. They're also used to modify the existing terms and conditions in the crop insurance policy. A separate request must be submitted for each producer and for each county for which the producer is requesting a change. Now, I am certainly encouraging all of you to sign up for our next webinar. It's going to be this Thursday, January 10th, and it's all going to be all about written agreements. So again, there is the website address, and if you click on the webinar you'd like to sign up for, again, that will be this Thursday. All right, so we're cycling down in our webinar. This is the last part that we're going to discuss, and probably the most important part, because we discussed a lot of issues during our webinar, and now you need to put all this into effect and go visit your local crop insurance agent. So let's take a look at some things to consider as we find a local crop insurance agent. First of all, we need to consider what insurance plan and coverage level is right for yourself. What plans are available for the crops you grow? What coverage levels do you qualify? How much can you afford to lose, and what makes the best financial sense? So let's go to the next slide, and this actually shows you a screenshot from the Risk Management Agency website. And I think all of us understand that the government is going through a shutdown right now, but this website is still functioning. So you can still go to the website shown here in the upper left corner of your slide. Once you get to that website, I want you to click on Find an Agent, and it's over here and it's circled in red. Click on Find an Agent. Let's go to the next slide, and once you click on Find an Agent, it takes you to the Agent Locator screen. Here on this screen, again, where it's circled here on the left side, I want you to click on the RMA Agent Locator, and this will take you actually to a search document. And I copied and pasted, I do apologize for it being rather small, but I wanted to get the entire screen on here. I copied and pasted just some search portions that you'll have to enter through. You'll have to enter a location. This could be an address, city, or a zip code. You can also search an agent name by distance. You can search by crop. Also, what language, Spanish, Portuguese, Korean are listed there. And then you also, there's a distance. You can also search by agent name towards the right-hand side of the screen. And then what counties they're licensed, or that agent's licensed in. So I would advise you to go through each filter and then hit the search button. So to summarize, the bottom line is I would encourage you to contact a local crop insurance agent before March 15th, which is sales closing. Discuss the crop insurance plans, how they fit your risk management needs. Your agent will also lead you through a calculation and a cost to determine what coverage is right for you. And then at that time, you can complete an application. I want to thank you for your attention today. I know this has been a lot of information thrown at you in 90 minutes, but I do appreciate your attention and answering all the poll questions. You will be receiving a survey tomorrow. I would like you to just take a few minutes, it doesn't take very long at all, to let us know how we did, because your feedback is very, very important to us. In the meantime, I'm going to turn this back over to Molly, and she will conclude our webinar for us.
And thank you, everyone, for your attention today. I just want to, we did have a couple questions, and there was a slide that had mentioned about a fall planted crop application deadline, which would be the fall sales closing date, which typically is around September 30th. Looking at the special provisions of insurance, it's going to have that exact date, but typically 9/30 is the sales closing date for fall planted crops. Another question was about the dairy revenue protection webinar, and there is a dairy revenue protection webinar scheduled for May 14th currently, and we strongly encourage you to participate in these webinars as much as possible. So be sure to check out the webinar page at cropinsuranceinaamerica.org. That's going to be your best resource for what's coming up, and also provide you the access for those links. So again, we thank you for your time today, and we look forward to being on a webinar with you soon. Bye-bye.